Hello, this is me, Tam Television, exploring United States stocks. This video is being broadcast simultaneously on our MyTam channel through a partnership with Me, June Television. Today, we're going to do a segment analyzing United States stocks and blue chip stocks together. In this segment, we show you how we analyze blue chip companies and early stage growth stocks based on data. It will be conducted in four main parts. We'll analyze whether it's a blue chip company, its expected performance, valuation, and current momentum using the Choisong system, and we'll learn how to interpret these factors. The company we'll cover today is called Daetadok. The ticker is DDOG, and the company's core business is providing a platform that monitors other companies' services based on the cloud or offers security-related services. It's a service that is usually renewed as a subscription service. Now let's take a closer look at each aspect. Datadog. If you look at the stock price trend over the past year, it's declined from its previous high, and compared to the previous low, the fluctuation from the 52-week high or low is quite significant. That means we can see that the stock price reacts very sensitively to even small changes in earnings or news. In the case of Datadog, it went up to $170 and then dropped all the way down to its previous low, the 52-week low, which is about a 50% drop, and that's in a very short period of time. Within 3 to 4 months, losses climbed to 50%. Also, for those who bought in here, it's a company where you could see fluctuations like nearly a 60% return in just 2 or 3 months. So, for those considering investing in this company, the volatility is quite severe. So you can see that it reacts very sensitively to things like earnings and news. So, if the earnings turn out better than expected, you'll see sharp jumps in the stock price, but if not, it could also drop significantly in a short period. You should keep an eye on these kinds of movements. We'll briefly go over a simple explanation of the company and check some of the risks related to it. First of all, this company is a global SaaS provider that offers cloud-based internet infrastructure, application performance monitoring, log management, and security management. In system planning for a specific service, for example, if our company has Choisong, for the Choisong service to run, all the back-end hardware, servers, and checks for when members join need to be in place. They provide a service that automates the checking of such systems, creates dashboards, and enables companies to efficiently manage those resources. So, internet infrastructure is basically about monitoring things like network traffic and similar aspects, and also checking whether the applications are running properly and if any issues have occurred. So, what we call a monitoring system keeps checking those things, and if a problem occurs, it sends a notification or message to the person in charge. The core service of Daetadog is to provide this kind of monitoring service so that customers can use the service without inconvenience through quick action. So basically, it's a subscription-based SaaS model. So depending on how much you use the service plan, whether you only use monitoring or also use logs or even use security management, the product price increases step by step. So, starting from the most basic plan, the pricing is determined either by a monthly subscription or by how much traffic you use. So I've talked about the main services, and the next thing to pay attention to is that the rate of customers adopting multiple products is very high. What this means is that this company has a lot of different product lineups. So at first, they only handled internet infrastructure, but as the company grew, they started doing application performance monitoring, and then, since hackers or other threats could break in from outside, they expanded further. They decided to include security management, which continued to boost the adoption rate of their subscription products. Companies using 2 or more services instead of 1 comprise around 80 to 85%. Then there are companies using 3 or more, and even 4 or more services, and the proportion of such companies is steadily increasing little by little. This shows us that they are getting locked into this company's services, and it's not easy to switch to something else all at once when you're already using these services. So those things themselves become factors that give the company an economic moat. So in that respect, it's a very good thing. Currently, there are no confirmed regulatory or legal risks or lawsuits for Datadog, so the risks in those areas are relatively low. However, the recent quarterly results showed that, as of the end of March 2025, the operating profit turned into a loss of $12 million. Originally, this company had been recording losses, but last year, for the first time, it turned a profit on an annual basis. However, the fact that operating profit turned into a loss in the first quarter is something we need to keep an eye on and pay close attention to. But there is a reason for this poor performance, and one of the biggest factors is that they significantly increased their R&D expenses. The fact that they greatly increased their R&D spending means that going forward they need to observe and incorporate technologies like artificial intelligence and L&M. So it seems they had no choice but to invest. The R&D expenses for those areas are likely mainly labor costs, which have risen significantly. Going forward, it's important to ensure these expenses are closely tied to sales performance. So, the operating loss of $1.2 billion isn't because products aren't selling, but rather due to R&D expenses, labor costs, and hiring people as investments. So, instead of seeing it as a typical risk from heavy losses, it would be better to understand this company from a different perspective. Our first question, is it a blue chip company? With a score of 53, it's just an average company. So, it belongs to about 34% of all listed companies in the United States. If you look here, our financial stability and cash generation are quite good. So, in the short term, we can interpret that the risk of this company experiencing any cash flow or financial issues is very low. Regarding future growth potential, it needs to increase more sharply. This part largely reflects this year's expected performance. As we reach autumn, next year's expected performance will become significantly more important. So, for next year's sales and earnings per share, it would be good to use consensus data to see if this part can rise sharply. When it's time to check during that season, our system will naturally reflect it automatically, so the scores will continue to change organically like this. Next, the profitability score is low at 30 points, and the reason it's this low is because, as I mentioned earlier, the profit margin just started to improve and it's not very high yet. So, there probably won't be any big changes in this area this year, but there's a possibility that the profit margin will gradually improve. So if you want to become a growth stock in the future, you need to have these three items, future growth potential, financial stability, and cash generation ability. These need to stand out sharply like a triangle. But in the case of Datadog, it has that shape in terms of financial stability and cash generation ability, but in terms of future growth potential, it's a bit less developed. So I think if this growth potential recovers, it could receive better evaluations in the market more quickly. Even if you look at the overall score over the past year, it was rising like this, but recently it has dropped a bit and is now at a standstill. So I think we need to see some movement toward recovery in these areas. We also check and update this score every day, but any significant changes will probably happen on a monthly basis. Still, we monitor it daily. So when new data comes in or changes, the score changes little by little, but it's not common for this score to change drastically. So if you find companies that are steadily growing like this, you can consider that you found an excellent company. So we're going to take a closer look at whether it's a solid company through the financial chart. This financial chart shows the financial statements as a graphical chart, and here we check if there are any issues with performance or risks. It's designed to quickly identify areas that might need further analysis or checking. You can assume the process is to find those areas and then open the original financial statements or the originals on electronic data gathering, analysis and retrieval to check how those parts were generated. Recent annual sales and profits have grown rapidly, showing significant increases in both operating and net profit, clearly demonstrating the company's fast growth. Based on 2024 figures, sales grew by 26% and net profit by 275%, so that's an incredibly rapid and high-speed growth. The second point shows that the operating profit margin became positive at 2% last year, marking the company's first profitable year. Everything below this 0 point indicates the company was in the red. So since this company has turned profitable and is growing, I think companies like this can build up some energy to move their stock price to the next level once they become a bit more stable. We need to check the net profit margin. It's unusual for it to be higher than the operating profit margin. If you look at Datadog before this, the blue and green lines move almost the same, right? Normally, since the net profit margin is lower than the operating profit margin, the green line should be drawn lower than the blue line. However, recent data from 2023 and 2024 shows the net profit margin is significantly higher than the operating profit margin. In 2024, the operating profit margin is 2%, while the net profit margin is a substantial 68%. So this happens because of non-operating gains and losses, and it's important to check these non-operating items. If these gains are likely to continue in the future, the net profit margin and net profit will remain high, so this is something that needs to be monitored. Next, if you look at the cash flow, companies in the growth stage usually show positive cash flow from operations, negative cash flow from investing, and positive cash flow from financing. For early growth stocks, most of the cash flow is positive from operations, negative from investing, and positive from financing. So this in itself is not a problem. But when we say the plus from financing activities, it means that cash has flowed in. Financing activities refer to borrowing or issuing new shares. A plus indicates money was brought in from outside. Bringing in $700 to $800 million through financing activities means they raised this amount, which has now come in. Zero is the baseline, so above it is a plus and below it is a minus. So it's important to analyze where this money was spent. In other words, raising the money itself is not the problem. So the next key point would be to analyze whether that money was properly invested or spent for the company's future and growth. I need to investigate two things. First, the significant difference between the operating and net profit margins. Second, if cash was brought in through financial activities, where it was spent and if it was used properly. If you look at and interpret this chart in this way, you can say that you've properly analyzed the financials. Next is the fourth and final financial chart. The current ratio stands at 263%, while the debt ratio is 113%. Among American companies, these are considered quite safe and high ratios. So, since they maintain a low debt ratio and a high current ratio, we can see that their short-term financial risk is quite low. These aspects are already reflected in the SMART score and our stock diagnosis score for financial stability, which was around 90 points earlier, right? So financial stability is already fully checked. So it checks the debt ratio, the current ratio, the interest coverage ratio, the proportion of borrowings and interest expenses. All of these are checked and counted for the score. If that score is high, you can basically consider it safe. So, if you are not yet familiar with reading financial statements or financial charts, you can just refer to the financial stability score in the SMART score and consider that you've checked everything. That score already includes all those factors. So let's check those two things I mentioned earlier. First, I want to check where the cash inflow from financial activities was used. Looking at the quarterly financial statement, the part circled shows that in Q4 2024, there was a cash inflow of $759 million from financial activities, indicated by the plus sign, signifying an inflow. The financial statement shows a positive amount for operating activities, followed by a negative amount for investing activities, and then another positive amount. This appearance is typical for growth stocks. However, if non-growth companies entering maturity start to look like this, it indicates increased risk. So it's fine if this appears when the company is in its early stages with high growth rates and is still growing. But if a company that's already entered the maturity stage and its growth has stopped starts to show this pattern, then it's correct to interpret it as a sign of risk. Since Datadog is in its early growth stage, it doesn't seem to be a major issue currently. If you want to see where this money was spent, I told you that it's correct to look at the changes in assets, in other words, to look at the balance sheet. So the balance sheet will clearly show how the funds were raised, and it will also show how they were used. When it comes to how the funds were raised, it's one of two things. It's either the liabilities increased or the equity increased. It's one of the two. If the equity increased, it means the company raised money by issuing new shares or selling shares to shareholders. This is also recorded as a positive in financing activities. It's the same with total liabilities. An increase in liabilities means that borrowing has increased, which also means the company has raised funds. So if you look at the data over the same period, you'll see that the biggest increase is in borrowings. Borrowings were $960 million in the previous quarter, but now they're $1.84 billion. So borrowings have increased by $870 million. So in the end, it was through borrowings that the company raised cash through financial activities. In other words, it wasn't mainly due to paid-in capital increases or anything like that, but rather the company raised funds by issuing debt or borrowing money. This much we can figure out. There will definitely be interest expenses. Then we need to take a look at where this money was spent. To see where the money was used, we look at the third item, the total assets. I told you to memorize this by taking the first letters from Dangje to Yumu, remember? Inventory assets, investments, tangible assets, and intangible assets, these four make up Jaya to Yumu. And the ones in front like cash equivalents, short-term investments, and accounts receivable. If you look at these three broadly, we can call them current assets. They're basically things close to cash. So, current assets is not actually an official account title. In the past, we grouped together account items that could be converted to cash within a year and called them current assets, mainly for calculating things like the quick ratio. But the term current assets itself is not an official account title. Together, these items are called current assets. Check where assets increased in Q2 2024. Cash equivalents increased from $33 million to $1.24 billion, which is an increase of about $910 million. Next, short-term investment assets increased slightly. If you look here, most of the increase came from cash equivalents. So how can we interpret this? They raised a lot of money through financial activities, but these financial activities were funded through borrowing. And even though they raised money through borrowing, where did they use it? They are holding most of it as cash equivalents. That's what this means. So the company didn't use it for M&A, nor did they use it to invest in tangible assets or facilities. Considering the lack of significant increases in other areas, the company is holding the issued funds as cash equivalents. We should consider the reasons behind the issuance and why they're holding it as cash, given that the company doesn't appear to need the cash. So what this all means is that when I looked up the disclosures from December 2024, it turns out they issued $1 billion in convertible bonds. So they bundled the convertible bonds together with the options to convert those bonds and issued about $1 billion worth in total. A convertible bond means it's a bond that can be converted, right? So a convertible bond is a corporate bond that you can change into something else. Then what can it be converted into? A convertible bond is a bond that gives you the right to convert it into stock. That's why in English it's called a convertible bond, or convertible bond for short. So a convertible bond, which we often refer to as 10, is a bond that can be converted into stock. So people who buy this bond can hold on to it. And if the stock price goes up, they have the right to buy the stock at a lower price, the price that was set when the bond was first issued. This gives them the right to buy the stock at that set price. So, for people who bought the bond, if the stock price falls, their return is simply zero. Especially the bond issued by this company has a coupon rate of 0%. That means there is no interest. So, the maturity is in 2029, and until then, the stock price has to go up so that investors can convert to stocks at a lower price and make a profit. From the company's perspective, since the coupon rate is zero, even though they issued convertible bonds, they don't have to pay any interest. That means they can raise funds very cheaply, and with this money, even though it's not stock, they have a lot of capital to invest in the company and help it grow. This is one of those cases. So, these cash-like assets can later become a factor that causes a difference between operating profit and net profit, as I mentioned earlier. Personally, I think Datadog might use these funds for future M&A or other investments. So, it's a company that has some financial and cash reserves. So, there are no major issues in financial activities. They raised funds, but instead of spending the money elsewhere, they currently hold it as cash equivalents and short-term investment assets, earning interest on those assets, and will use this money for something later on. A sudden increase in cash from financial activities doesn't necessarily mean the company raised funds due to a cash shortage. That's the correct interpretation. Second, this is somewhat related to the financial activities mentioned earlier, but it's necessary to analyze the operating profit and loss, since there was a big difference between the operating profit margin and the net profit margin. So it's really important to check what the cause is and whether it will continue. As of December 2024, the annual operating profit was around $20 million. However, it began to increase significantly from 2023, reaching $100 million in 2023 and $150 million in 2024 last year. The net profit was $180 million, while the operating profit was only $50 million. They did turn a profit, but the non-operating profit is really big, so it's very important to check whether this non-operating profit will continue in the future or in 2025 as well. Then we need to take a look at why this operating profit occurred, and most of this operating profit actually came from here. Operating profit here refers to the valuation gains generated from the short-term investment assets that this company is investing in. We call this a fair value valuation gain. So if you look at the videos I've recently recorded or the previous ones, you'll find some of that content. So fair value valuation means that when I invest, the amount I invested changes as the market price changes later on. The valuation amount comes from those changing market prices. If I bought a stock at $100 and its value increased to $150 by year end without selling, there's a $50 per share valuation gain. That is usually recorded as non-operating income. Another thing is, like with Datadog, the value of these assets can fluctuate due to investments, or you might earn interest from them. These kinds of things can happen. I looked it up, and out of $1.24 billion in cash equivalents, $1.19 billion is invested in MMFs. They're called money market funds, so they're not actually cash, but financial products. Since they're invested in these, some valuation gains or losses occur from them. Next, there's also short-term investment assets. As the name suggests, these are equity holdings with marketability. The company has $2.9 billion with $1.89 billion in corporate bonds and $460 million in government bonds, totaling nearly $2.3 to $2.4 billion. Besides these, there are also some other bonds and equity holdings. I decided to leave those out for now. To sum up, most of the short-term investment assets and cash equivalents are in MMFs, corporate bonds, or government bonds. Since these are considered short-term investments, it means that most of them have maturities of less than 1 year. If the maturity is more than 1 year, even if it's the same government bond or corporate bond, if the maturity is longer or you don't plan to sell it within a year, then these are all classified as long-term investment assets. Even if I hold the same stock or a company bond with a 3-year maturity, if I plan to sell it within a year, it is classified as a short-term investment, or if the maturity itself is less than 1 year remaining. So, in the end, what this money means is that as of March 2025, if you look at this as $1 billion and $3.3 billion, you can see that cash equivalents have decreased a bit by about $200 million. Short-term investment assets increased by approximately $200 to $300 million. So, what this means is that we can interpret it as moving some of the cash equivalents into short-term investments with higher interest rates and profitability. So, they're currently holding about $4.4 billion. So, Daetadog has about $4.4 billion in cash flow that they can immediately use if the company decides to spend on M&A or invest in something else. So I think they probably won't just leave this money sitting like this forever. So this is the area where we can speculate that some policies about how to use this money might come out. So it's the same with the current operating profit and loss. Since valuation gains are coming from this part, it's likely that there will continue to be valuation gains in the future. That's how you can interpret it. Let's examine our stock price and expected earnings. The stock price fluctuates significantly, dropping sharply at times, but in the long term, the earnings per share is rising and recovering, as I mentioned earlier. So as long as you get the valuation right, you can find good investment points. The earnings per share is recovering and trending upward, so you can look at it that way. And our ChoiceStar app has been released. If you download the app, we will soon launch a service that automatically sends you articles via push notifications when earnings are released around July 10th. We're launching the beta service, and we've invested a lot in our system resources so that not only premium members but also free members who set up their interest information can all receive it. So you need to download the app and make sure to allow push notifications in order to receive that information. So I think it would be good if you use it that way. Yes, now let's take a look at the projected performance. In 2025, sales are expected to grow by about 20%, and if you look up to 2027, the average annual sales growth is in the low 20% range, so you can see that sales are still growing significantly. Next, regarding the earnings per share, although it appears to decline in 2025, if you look at 2026 and 2027, it recovers at a fairly rapid pace. Looking at the earnings per share, in 2026 it grows by 210% to $0.35, and then in 2027 it grows by 105% to about $0.70. I think at that time it will probably reach an all-time high. So the possibility that earnings per share or net profit will reach an all-time high in the future is very high. Because it's a subscription service, the cancellation rate isn't that high. So once the subscription is set up like this, stable cash flows come in, and with those cash flows, the company has the capacity to invest elsewhere. You could say it's a company that belongs to an industry with a good business model. It's a bit unfortunate when you look at the valuation. Datadog has almost never been expensive. If you look at the yellow line over the past year, it's very undervalued, very undervalued, very undervalued. I'm not sure why it was abandoned to this extent. But even though it has recently risen by up to 50%, it's still on the undervalued line, so this company is quite undervalued. However, the stock price volatility is still very high depending on the performance. So I think it would be good to keep an eye on market trends, recent issues, news and earnings announcements, especially with another earnings season approaching soon. So instead of deciding to buy right now, it would be better to wait until after the earnings announcements come out, check those results, and then make your decision. Even then, the prices will still be attractive, so I think it would be good to make your judgment that way. Next, if we look at the stock price momentum, this company had a golden cross around May, and now the moving averages are in the correct order. For short-term analysis, use the 5-day, 21-day and 61-day moving averages. For mid to long-term momentum, click the midterm option to view the 21-day, 61-day and 120-day moving averages. Right now, after it first appeared, the period when all the moving averages, the 5-day, 21-day and 61-day, are in the correct order is about this section. Around here, you can see that the overall momentum shifted in a very positive direction, and that trend is continuing to spread right now. Right now, the 5-day, 21-day and 61-day moving averages are all lined up in the correct order. If you look at when the stock price was falling here, all the moving averages were in the wrong order, and it's been about a month since they started lining up correctly. So unless the stock price takes a significant hit from earnings, we can say that momentum has come in, and there's a good chance it will hold up well in the market. Now let's move to our service site and quickly review the current situation of Datadog. For Datadog, the current trading signal is to hold. The signal was given at $105, and right now it's still in a holding state, so we're holding at the moment. If you look on the right side here, you'll see a heart icon. If you click this heart to add it to your favorites, you'll receive push notifications for news, updates, or when the trading signal changes. For premium members, you'll get push notifications for all trading signal changes as well. For free members, whenever there are news updates or other good content in the future, we'll send you everything we can for free through push notifications. Make sure to set your favorites and install the app, and don't forget to enable push notifications so you can receive all the information. So, it would be great if you could change those settings, especially for premium members, since you need to receive that information later. If you haven't turned on push notifications, please make sure to switch them on so you can get the updates. If you look at the trading signals, you can see a buy signal here, and since the price has been rising steadily, you could say that the momentum is still alive right now. Next, if you look at this part called the exponential moving average chart, you can see that around May 30th, at the end of May, there was a change and the momentum started to improve. On the midterm chart, you can see the 21, 61 and 121 moving averages. This is actually a very midterm signal, and a signal that lasts for quite a long time, and it's just about to change right now. The 61-day moving average is at $116 and the 121-day is at $117, but since the current price, the 5-day and the 21-day moving averages are all higher than that, it's just a matter of time. It looks like there will probably be a crossover, and if that happens, it means we're entering a phase where the momentum improves even in the midterm. Next, some of you might be curious about the price-earnings ratio below. From our perspective, it's undervalued. But if you look at the price-earnings ratio, the current price is 271, so you might wonder, is this really undervalued? That's a question you could have. Next, if you look at the data on the right, it says performance, and the F here stands for forward value. So it's the estimate, meaning there are projected earnings for this year, right? Considering those earnings, how many times is it? The forward value and current price-earnings ratio at 271 times are already very high. However, the estimated price-earnings ratio is even higher at 1,126. This sudden increase in price-earnings ratio raises questions about whether the stock can be considered cheap given the current situation. To explain that a bit, valuation isn't calculated using only the price-earnings ratio. So, there's price-earnings, ratio price-to-sales ratio, price-to-cash flow ratio, price-to-book ratio, and also enterprise value, earnings before interest, taxes, depreciation, and amortization. There are various types of valuations. In our valuation system, we identify the most optimized valuation method for each company. Using the formula that fits that company, we determine the multiple to apply. This is all done through a quant algorithm. This company doesn't use the PDR, and let me explain why. If you look below, you'll see that this company has been running at a loss until recently. For companies that have just turned profitable, their earnings per share values aren't high. Since the market cap and stock price are high, but the earnings have just turned positive and are still at a very low level, the price-earnings ratio, which is price divided by earnings, ends up being very high because the earnings are still quite low, even though they've turned positive. But since the stock price is already set very high, when you calculate the price-earnings ratio, it comes out to several hundred times. So for companies that have just turned profitable, valuing them using price-earnings ratio doesn't make sense. It's meaningless. So as profits increase, the price-earnings ratio will drop sharply, so that part doesn't really matter much. So for companies that have just become profitable, it's actually better to use things like price-to-sales ratio, enterprise value, or earnings before interest, taxes, depreciation, and amortization price-to-cash flow ratio, or cash flow methods instead. So in the case of Datadog right now, it's just turned profitable, so the price-earnings ratio is high because the stock price is very high. That's why we don't use price-earnings ratio for valuation. Second, you might wonder why the expected price-earnings ratio for next year suddenly increased so much. As I mentioned, price-earnings ratio is calculated as P divided by E. P can be the market cap divided by net profit, and if you divide both by the number of shares, P becomes the stock price and E becomes earnings per share. Earnings per share is earnings per share and price is the stock price. So it's price divided by earnings per share, but if the price stays the same, what happens to the earnings per share? It's expected to be $0.11 this year, down from $0.52, which is almost a fifth of what it was. So if the price stays the same, but earnings per share drops sharply like this, what happens to the price-earnings ratio? It would skyrocket, right? So the reason the forward value is rising by about 4 to 5 times right now is exactly because as the earnings drop by that ratio, the price-earnings ratio has no choice but to go up by the same amount. So, as I mentioned before, price-earnings ratio doesn't really have much meaning in Datadog's valuation, and price-earnings ratio forward is even less meaningful. You could say it has no significance at all. So right now, it's more appropriate to value this company using a different method. That's how you should interpret the price-earnings ratio in this case. And as I mentioned earlier in the textbook, you can see all these finance-related parts here. So if you go into the financial section and look at the financial charts, you can check how things have changed and review all this data. Next, if you click on the Financial Statements tab, you'll see what I mentioned earlier here. This is what I was talking about. Here, you can see that the cash flow from financing activities suddenly jumped. If you ask what caused this jump, it would be either liabilities or equity. Looking here, you can see that borrowings increased. And if you want to know where this borrowed money was used, you check the assets, as I mentioned before. The sudden jump is evident in cash and cash equivalents. Cash and cash equivalents have increased significantly, indicating the company hasn't invested the funds elsewhere yet. The 1.2 billion won is held as cash, and further details on its composition can be determined if needed. In December 2014, you can access the Electronic Disclosure Overview screen and connect immediately. A feature takes you directly to the Securities and Exchange Commission or German Electronic Disclosure data. Clicking it opens the disclosure right away. In December, 10Q is for quarterly reports, 10K for annual reports, and 8 for provisional results. So here it says 10K annual report. You click on the filing and then click on the first 10K listed. Information appears on the left side. If you look in this section, you'll find all of this in the notes under the financial statements. Here, the cash and cash equivalents I mentioned earlier are on the balance sheet, so you can open the balance sheet or you can just search for the asset item called cash equivalents. If you type in cash, the item will come up. From that item, I found out earlier how they invested in things like MMFs or bonds. When you look for it in that way and want to see the details, you have no choice but to come to the original electronic disclosure. If you train yourself well using those methods, I think it will be very helpful when you analyze other companies as well. That's all for today's Blue Chip Stock Analysis segment. If you found this helpful, please subscribe, like, and leave your support and comments. Thank you.